In terms of is high frequency trading fair, I think that's a difficult question to answer because fair is an extremely subjective word that's shaped by our own worldviews and influenced by our upbringings. I like to flip the question a little and ask, is HFT unfair? So yes, there is a difference. There's a quant developer, quant trader, and quant researcher. I'll just focus on the first two, quant developer and quant trader. A quantitative developer is a technologist at heart. They're really responsible for designing, building, maintaining all the critical trading infrastructure at the firm that powers its operations. The goal of the quantitative developer is to not only, like I said, build trading algorithms that run independently of any human intervention, as in the case would be with HFT, but it's also to build tools that allow traders to make the most informed trading decisions.
So on February 9th, 2021, the CEO of Robinhood, Vlad, tweeted out in response to the whole GameStop and versus hedge funds debacle, what exactly is high frequency trading and is it evil? Which gave rise to one of my favorite memes of it saying with the William Dafoe meme, you know, I'm a bit of a retard myself. So that is why we have Coding Jesus on the show today. Coding Jesus is a high-frequency trading developer, meaning that he actually writes the code that these high-frequency trading firms use and deploy into the markets. And he is one of the only people talking about high-frequency trading on YouTube, which is part of the reason why I reached out to him. He also has really clear, easy-to-understand explanations of what's going on in the high-frequency trading space. So I thought he was the perfect person to bring on to the show today. Let's see. And just so you guys know, in the finance space, there are very strong NDAs, non-disclosure agreements, because of all the money and proprietary stuff involved. So we did have Coding Jesus run through all these questions with his compliance department to make sure everything is okay. And if I veer off course and I ask him something that he can't answer, he'll just tell me he can't. And that is the reason why, just in case you guys are wondering. So let's see. Is there anything I missed in the intro that you would like to say really quick before we get into it?
What I'd like just to say is the term high-frequency trading developer. I prefer the term quantitative developer because the scope of my work is much more broad than just high-frequency trading strategies. But it does include that in the mix.
All right, perfect. We'll get into that more later. And would you like me to refer you as Coding Jesus, or do you have like a first name you want to go by?
Let's go by Coding Jesus.
All right, sounds good. It's a very appropriate name too.
Yeah.
All right, let's start with that. So what's the story behind the name, Coding Jesus?
The story behind the name was long hair, beard. I'm Israeli. You know, Jesus was Israeli as well. I'm Jewish. Jesus was Jewish. I thought it would be a nice name to be able to attract attention on YouTube, to catch people's eye, and an easy name to associate with my channel.
Right. All right. So let's start with, what exactly is high frequency trading to answer Vlad's question?
Yeah, high frequency trading is just a segment of a much larger world, the world of algorithmic trading. It's a catch-all term to describe trading strategies whose success or failure solely rely on speed of execution or latency.
Can you elaborate on speed of execution for those that aren't familiar?
Yeah, so oftentimes when we're looking at a computer, we blink our eye, things are already gone. Speed of execution and latency is referring to the amount of time it takes for me to submit an order to the exchange and receive information from the exchange to me. And oftentimes when we're looking at high frequency trading strategies, we're not dealing with seconds, milliseconds, or even microseconds. We're dealing with nanoseconds.
Nanoseconds. So when you're coding these high frequency trading algorithms, you program stuff to operate in like nanoseconds. So how does that like process work of like writing in nanoseconds?
Yeah, the process is really oriented around building clean architecture, making sure that the path that executes a given trade or a given strategy is clean. There isn't any I/O involved, meaning you're not saving to a database, you're not writing to a file, you aren't doing anything that's erroneous to the actual process of doing what you need to do, which is receiving market data, processing that market data, understanding what that market data means, and then shooting a message to the exchange. So it's making sure that that critical path is clean at all times, and that's the gist of it.
All right. Yeah. Because before YouTube, I was a web developer, and I know companies will optimize their code from like Python and translate it down into C, like the bare bones C code, to make sure everything, like there's no fluff. So that's kind of what you're doing here, but just towards the stock market or whatever market.
Yeah, it's similar. The primary languages are C++. There might be a layer of Python or C# involved as well.
Awesome. So there are a lot of different segments to coding. There is web development, mobile app development, game development. What made you choose the world of algorithmic trading or quantitative
Trading.
development? Yeah.
Right. So I previously worked at a cryptocurrency exchange in Hong Kong, and I've always been interested in the bleeding edge of technology and financial markets. My degree was in finance, and so I wanted to mix the two together. And that's when I decided to apply to several different proprietary trading firms. Now, a lot of people think that the world of proprietary trading or HFT is very opaque. And it is true that there are a bunch of NDAs, a lot of things you can say because of intellectual property policies at the company you might work at. But the actual interview process is very transparent. It's the exact same process you take to apply to places like Facebook, Google, Amazon, Apple, etc. So in my case, and I think a lot of other people in the space's cases, there's a couple of round of interviews. Those range from maybe a technical quiz online to a behavioral interview with HR to a more technical interview with your would-be team where they fly you out to their office for the interview.
How do you like being a high-frequency trader in general?
Being a quant developer is very fun. There's a lot of challenges that you need to tackle day to day. Every day is different. The market is dynamic and constantly changing. And as a result of that, you also need to tweak your own skills and remain at the top of your game at all times. Over the weekends, I read books about C++. Occasionally, I might do my little side project here and there outside of work, my own little personal projects. And so it requires me to always be at the top of my game, which is what I like a lot, and continuously learning.
All right. So what does the day-to-day life look like in that kind of job?
The day-to-day life focuses around finding and fixing bugs. So you get bug reports from traders. It also looks like interviewing candidates for the position. It looks like maintaining critical infrastructure. It looks like building upon a continuously growing pipeline of infrastructure that will eventually help traders make more informed trading decisions. And that's why at the beginning of the video, I said that algorithmic trading is made up of a wide variety of different things. High frequency trading is just a part of it. So you do have your FPGAs and you do have your high frequency trading strategies, algorithms that interface entirely mechanically. There is no human intervention. But then you also have the front end GUIs you build for traders, the back end systems that are required to crunch prices, disseminate information, et cetera, et cetera.
Okay. So there's a difference between a trader and an actual quantitative developer, right? Can you explain the difference?
Sure. So yes, there is a difference. There's a quant developer, quant trader, and quant researcher. I'll just focus on the first two, quant developer and quant trader. A quantitative developer is a technologist at heart. They're really responsible for designing, building, maintaining all the critical trading infrastructure at the firm that powers its operations. The goal of the quantitative developer is to not only, like I said, build trading algorithms that run independently of any human intervention, as in the case would be with HFT, but it's also to build tools that allow traders to make the most informed trading decisions. That can be anything from an application that allows them to submit custom strategies, so to build their own custom instruments, to servers whose roles are to crunch information and disseminate prices, to tools to display risk for them, and even audio applications that would provide traders with real-time audio alerts. Quant traders, on the other hand, are responsible for managing and growing the firm's P&L while managing their risk in doing so. So they're the ones executing on proprietary trading strategies and ensuring that those strategies positively impact the firm's bottom line. And the way I like to conceptualize it or abstract it is that quantitative developers are the shipbuilders. They're building the ship. And the traders, which all lie under a desk, that's the term, a desk of traders, man the ship. So you have the head trader for the desk. Maybe he's the head trader on the gold desk or the water desk or the Bitcoin desk, and he's the captain of the ship. And his crew are made up from anyone from an intern trader to junior traders to senior traders, etc.
Okay, and the developers are like the engineers and the mechanics of the ship, kind of. Not the best.
Exactly. And even in the actual work environment itself, you'll see in a lot of proprietary trading firms, it's very open. You can call to somebody out at the other end of the room. Quants sit in one place, traders in another, developers in another, and it's a constant, back and forth between all parties to grow the firm and grow its P&L.
P&L being profit and loss for those
exactly.
who don't know. So what's the role of, so when we refer to the word quants, are we referring to the researchers or the traders?
We're referring to the researchers.
Okay. What exactly do they do in a nutshell?
What their role is to develop complex mathematical models to price options and manage risk. That's their role in a nutshell. Now, that involves having some sort of background in mathematics and also having an understanding in a higher level language like Python that will allow them to grind through terabytes worth of data to generate models that, like I said, will price risk, inform traders about decisions, maybe build some tools that have some sort of predictive capacity to them, but in general to price instruments and manage risk.
And I'm assuming they hand off that research to the traders and you guys kind of all communicate together. Is that kind of how it works?
Yeah, so quants are focused on really pushing the firm forward in terms of new models that will come out to adjust to market dynamics and price different instruments. They then pass that on to software engineers that go ahead and implement that into their own architecture. So the quants come up with kind of the initial cursory models written in Python. The developers, the quant developers, then implement that in C++, C#, maybe Python as well. And then the tools that the developers made, thanks to the quants, are then used by the traders to execute on strategies developed by the quants. So it kind of goes around.
Yeah.
The traders end up giving feedback to the quants to improve on their models, and it's kind of a full circle.
Okay, interesting. So 3 kind of main segments. So
exactly.
When people hear the term high frequency trading, it's pretty vague and kind of hard to understand. So could you give us some examples of high frequency trading algorithms or strategies without breaking any NDAs and whatnot?
Yeah, sure. There's 2 generic strategies that quantitative trading firms may employ that come to mind. The first is called price arbitrage. So the day-to-day of a trading firm involves quoting tens of thousands, if not more, securities every day. And in doing so, they're generating theoretical values for dozens, if not hundreds, of option complexes. So that means that if the price of an option veers dramatically away from the firm's theoretical value, they will either buy or sell that option and push it towards its theoretical value, what they deem is correct. Now, when they buy or sell that option, they'll capture what's called edge, which is just a fancy word for profit. And they'll secure that edge by hedging out their newfound option exposure with the option's underlying futures contract. Now, capturing that edge via price arbitrage is an extremely competitive endeavor, often relying on speeds of several hundred nanoseconds. So the second strategy, and this is the last strategy that I feel comfortable publicly talking about, is called statistical arbitrage. Now, statistical arbitrage is sometimes referred to as stat arb, and it's a market neutral strategy that takes advantage of inefficiencies in pricing between correlated groups of securities. Now, I make the distinction groups of securities because there's also another strategy called pair trading, which focuses on only 2 securities. But in this strategy, in stat arb, we're focusing on groups of securities, like baskets of options. So what ends up happening in markets is that you might have price inefficiencies that last a duration of between milliseconds to as long as days or weeks. And this strategy often involves buying a group of securities one believes is undervalued and selling a correlated group of securities that one believes is overvalued under the assumption that because they're strongly correlated, their discrepancies will eventually come together and realign. That's called mean reversion. And to give you a little example, let's say we have Pepsi and Coke. These are just 2 securities, but like I said, stat arb focuses on a group of securities. So Pepsi and Coke have a very strong correlation that has persisted over time as 2 competing companies. Now, if Pepsi and Coke are trading like this, and Pepsi's share price starts falling and becomes uncorrelated, untethered from that of Coke, then a trader will potentially buy Pepsi and sell Coke in anticipation that those 2 share prices eventually realign. Now, while this strategy has the word arbitrage in it, statistical arbitrage is a bit of a misnomer here, given that the strategy is not truly risk-free. So for example, if Pepsi, comes dislocated, but then it goes bankrupt, then the company would cease to exist, and any correlation that you previously discovered over a larger time period would prove useless. So the 2 strategies that come to mind, price arbitrage and stat arbitrage.
Okay, interesting. A lot of questions. So with price arbitrage, so just to make sure I'm getting this clearly. So you basically use math and stuff to predict what you believe the value of a security should be. And then if it deviates from that value, it goes up or down to the prediction you predicted. Then you would buy or sell against that and then hedge the difference to protect your risk. Am I getting that correctly?
Yeah, you're getting that most likely correctly. Like the general idea is correct. Only I would just change one of the terms that you use, like predict. In high frequency trading, there is no prediction. There are only numbers, a model, and an outcome. A lot of different high frequency trading firms might use different types of models. There's a Black-Scholes models, there's Bachelier models, there's a bunch of different models to price options. And there's only a couple of inputs, the futures price, interest rates, volatility, et cetera, and that outputs a price. And that price is what the option is worth at this point in time. There's no predicting what it will be worth later. It's all about what it is at this point in time. So you got the general idea. I just wanted to make sure the distinction between now and prediction is made clear.
Yeah. And with stat arb, you're basically looking at a group of securities that are correlated. And if one deviates from that correlation, it goes up or down, then you buy, sell, etc.
Exactly.
Okay, interesting. All right, so let's see. So now that we have a general idea of HFT and some of these strategies that you guys use, HFT has a lot of criticism for it, and I want to get into those. So in your opinion, is high frequency trading fair? Because some people explain it like you're jumping in front of the line, you're kind of like a scalper. So what are your thoughts?
Yeah, so I'll address kind of the fair part and then the scalping part. Yeah. In terms of is high frequency trading fair, I think that's a difficult question to answer because fair is an extremely subjective word that's shaped by our own worldviews and influenced by our upbringings. I like to flip the question a little and ask, is HFT unfair? Now, when I think of unfair, I think that somebody is either being coerced into some sort of transaction or one party has some sort of inherent advantage or systematic advantage conferred to it by some partial arbiter. And that is not the case in high frequency trading. In high frequency trading, your ability to turn a profit is directly correlated to the talent that you can hire and the amount of capital that you have on your disposal. There's nobody stopping you or anybody else from starting your own high frequency trading firm. So when two parties enter into a transaction, it's entirely voluntary. Whether the party on the other end is an algorithm or a Redditor, it really doesn't matter and it shouldn't matter. So to answer your question, is high frequency trading fair? Based off my professional evaluation, I would say it is fair.
Okay, and your reasoning is because it's not like the government is giving you guys some inherent advantage over retail investors. Anyone can buy the computers, hire the developers and quants and researchers, etc., and do the same thing you guys are doing. So pretty much like a free market.
That's exactly it. And the exchanges don't confer some sort of privilege on us. All the information regarding market makers is public online. All the information regarding how market data is disseminated is public online. There's no fast track because you are a high frequency trading firm. We get treated the same as everybody else.
Okay, makes sense. Oh yeah, one more question.
On scalping as well.
Yeah, yes.
Okay.
After this quick question. So online, I've read like there's two main types of HFT, market making, and another one, I believe it was stat arb. So is that what you explained earlier, or is it a little bit different?
Yeah, there's a version of HFT for every HFT firm. I mean, not everybody runs the same strategies, and not everybody even generates the same prices, the same expected prices for options. Everybody has their own inputs that they put in based on what quant researchers produce in terms of, what should the volatility be, what should the interest rate be, et cetera. So yes, there are two types, the market makers and statistical arbitrage, but there's also price arbitrage. There's a strategy for every different high frequency trading firm out there.
Okay, let's address that other thing then. So another criticism of HFT is it's kind of like scalping, where you go to a concert, buy up all the tickets, and then sell them back to people who didn't get there in time at a higher price. Your thoughts?
Yeah, I wouldn't say HFT is like scalping at all, really. Scalping is based on technical analysis as opposed to rigorous mathematical models generated by quantitative researchers that play with petabytes of data. With scalping, day traders try to make a very large amount of small trades in the hope that will lead to larger profits. Now, while you hear the words large amount of small trades, you might think that those are characteristics in HFT. That is true, but like I said, the rhyme and reason is totally different. Scalpers hold their positions for seconds to minutes. HFT algorithms are in and out in a blink of an eye. But I think the real critical difference here is actually the risk profile between what scalpers do and what high frequency traders do. High frequency traders have asymmetric risk while scalpers have symmetric risk. Now, what do I mean by that? In the strategy that I talked about before, price arbitrage, for a given quantity and price that you fire for, you see an opportunity, you fire for it. You either capture that edge, hedge it out, and that's considered your profit. Or if somebody got there before you did, then your order is eliminated. You're not matched against anybody, and it's like you didn't go for that opportunity to begin with. So with HFT and price arbitrage, there's only upside and there's no downside. But when you think of scalping and you think of a day trader, he enters into a scalp trade not knowing whether that scalp trade will be profitable or whether it will be a losing scalp trade. So he has a 1-to-1 risk reward ratio. The price of the stock or whatever he's trading can either go up or down. So while high frequency traders have an asymmetric risk profile when it comes to price arbitrage, scalpers do not. They have a symmetric risk profile.
Okay, so are there HFT firms that enter into these trades for nanoseconds to do scalping, or is it a longer time frame than that?
I wouldn't say that they enter to do scalping, because like I said, when I think of scalping, I think of like technical analysis. You buy a bunch of times and then you might lose a lot if you pick you buy the peak and then it falls and you're like, oh shit, all the profits I made on the way up scalping have been eliminated on the way down. The same dynamics don't apply to HFT. Like I said, if you either capture profit or you don't, there is no, I bought something and all of a sudden the price collapsed and I lost money. It doesn't work like that. If you buy it, you capture that edge, you hedge out your risk, and that is technically considered risk-free profit for you.
Okay. So what you mean by asymmetric versus symmetrical risk, you guys don't enter into trades if the reward isn't there. You just like stay out of it, compared to scalpers who enter into it hoping that it goes up, but it can go down too. Is that correct?
Right. But even if we fire for an opportunity that was previously very attractive and rewarding, but now isn't because somebody else got there before us, we still don't lose anything. Because all that happens is the opportunity we went for disappeared. Our order is simply eliminated. It's not matched against anybody, so nothing is lost.
So the majority of your trades are profitable? Or like all of them?
I can't speak towards my firm specifically, but all I can say is that a firm won't fire for an opportunity that would lose the money.
Okay, so on average, are these profits like a cent? Fractions of a cent? Few cents?
It depends on the quantity and price. Every opportunity is different. I've seen very large opportunities and very small opportunities. So it really ranges just how juicy the opportunity is.
Right. And even if it is like a fraction of a cent or a cent, if you do these type of trades millions of times a day, it still ends up being a substantial amount of money. Is that correct?
It adds up.
Yeah. Okay. So the 2010 flash crash, the flash crash of 245, the main blame contributes to high frequency traders, among other explanations. So how much do high frequency traders contribute to these flash crashes and a general fragility of the markets?
Yeah, it's a good question. I'm glad you asked it. Flash crashes, in my professional opinion, are actually made less frequent due to the presence of high frequency traders, or in other words, flash crashes are made more frequent by the absence of high frequency traders. Now, there's a bunch of smarter people than me that did their own research into the CME. Researchers at the CME did their own research into what happened on May 6th, and they issued a report. And I'd like to quote you just a couple of sentences from there. There are people a lot smarter than me, and they came to the conclusion, and I quote, there is no visible support of the notion that algorithmic trading models deployed in the context of stock index futures traded on the CME group exchanges cause the market fluctuations in question, referring to May 6th. Furthermore, we find no evidence in CME stock index futures of any undue concentration of activity amongst algorithmic or any other types of traders. It's difficult to attribute the declining market action to any concentration of high-frequency traders. Rather, we suggest that HFTs may have had the effect of providing a buoyant function in the market. So what the CME here is actually saying is that HFTs actually acted as a shock absorber during a period where investors were dumping. Investors got taken control by animal spirits. They started panicking, they started selling, but algorithms couldn't feel that fear. So even when S&P E-mini futures were dumping, HFT algorithms were still jumping in and out, continuously quoting, and they were absorbing the shocks on the way down due to panic selling. So it's my opinion that, it's not only my opinion, it's backed by the CME's own internal report, that if HFTs weren't present in May 6th, then the flash crash would have actually been much worse than what it was.
Interesting. So what do you think the cause of the flash crash was? I know there's a lot of different explanations.
To be frank, I'm not entirely sure. When I was doing research, it seemed like there was some very large $12 billion order on E-mini S&P futures by some Midwestern brokerage.
Yeah.
What happens is oftentimes when HFTs hear of a very large amount of quantity hitting the order book, they might hold their quotes to regroup. The reason being is because they're quoting the order book on both sides. And when they hear a massive order that might cause a swing, they will pull their quotes just for a brief period of time to regroup. What will then end up happening is they will come back into the market. But if quotes are pulled even for a very short amount of time, price needs to resolve somewhere. You're selling $12 billion. Price needs to resolve somewhere. And if somebody's selling $12 billion in, then price needs to resolve, and it will resolve lower. And when people see a slight downtick, it's not algorithms that are getting scared. Algorithms can't get scared. There's no emotion here.
Yeah.
It's retail investors, or maybe even more advanced, I'm sure it was primarily more advanced investors that start selling, start panicking. That's why I said the animal spirits take over and they start pushing the price down.
Interesting. Can you link to that? Send me a link to that too?
Yeah, I'll do that.
Perfect. There's a lot of criticism of HFT over the years. What do you think about like the general sentiment that HFT is bad?
Yeah, it's a blanket term. When I think of, to say HFT is making the world worse or making the world bad, I'd say that I personally think that you can only make that statement if HFTs are destroying value or harming somebody. I think it's difficult to make the case that HFTs are harming somebody. HFTs enter into trades just like I do with my own personal brokerage account, just like you might do, in a voluntary fashion. There's no coercion. Nobody's being pushed or forced to do anything. And whether the other person on the other side of the screen is a Redditor or it's an algorithm, it really shouldn't matter. And in practicality, it doesn't matter at all.
Right. Because I know one of the main benefits of HFT is that the spread between bid and ask prices have gone really very much downward since the inception.
Yeah, that's a benefit. Of course.
Okay. Do you think there's another subjective question. Do you think there's a big opportunity cost where we're employing like some of the smartest minds in math to make a few cents per trade when they could be doing something in regards to like space or something? What do you think?
Sure. I thought of this a bit. I don't think so. For starters, I'm kind of like more of a live and let live type person. I don't think other people have a role in telling you what to do with your life. If somebody wants to be a writer, write. If you want to paint, paint. It's as simple as that for me. But going beyond that to the actual tangible implications of a mathematician working on a quant research desk as opposed to, a spaceship, I think that HFT still has a very tangible impact on the world, and their contribution would be useful in high frequency trading. High frequency trading, or the impact of it, stretches beyond financial markets. For example, let's say there's a new company that wants to go public. Now, they rely on quantitative trading firms to market make for their IPO. The reason being is if investors don't have confidence that there's a market, that there are participants, that they can sell their shares publicly after the IPO, then they'll be less inclined to subscribe to that IPO. And if they're less inclined to subscribe to a given company's share issuance, that company can't raise money. And if they can't raise their desired sums of investment, then they can't produce products and services that at the end of the day benefit people like me and you, consumers. So if they can't produce those things, nothing new happens. There's no innovation, and our living standards just tend to stagnate. Now, beyond this abstraction, like you said, actually, HFTs also have more tangible impacts on financial markets themselves. They lead to, like you said, lower bid-ask spreads, which saves retail traders maybe only pennies on the order. And on the surface, you might ask yourself, who cares about pennies? But in the grand scheme of things, that saves retail traders billions of dollars annually.
Interesting. That's a really good point in regards to IPOs and stuff and raising money. Can you explain what market making is for people who aren't aware? It's a very vague term.
Sure. Market making is the practice of always providing a bid and an ask. So in order for a market to function, you need somebody that will continuously be willing to buy at a certain price and sell at a certain price. Now, when I think of a market, if I go to some stall somewhere, I'm the guy selling. I have no interest in buying, but I rely on there always being somebody there to buy and sell, because if I'm selling, I need to find a buyer. And if somebody's buying, they need to find a seller. So a market maker is somebody that's designated or who employs himself in always providing a bid and an ask all the time, or most of the time.
Okay. And even if there isn't, if I wanted to go sell a stock that I own, Tesla or GameStop, and if there's no buyer, the market maker will still buy it from me. Is that how it works?
Yeah. So if there is no retail buyer, there's no like average Joe wanting to buy Tesla, then it's the market maker's role to facilitate that buy. There are certain rules to qualify as a market maker, and all this is public information. There are certain rules to qualify as a market maker in exchanges like the CME. And I'm not exactly sure if this is one of the rules, but I've heard this before, that you need to have some sort of uptime in terms of how often you're quoting. So you need to maybe be quoting at least, 80% of the day. You need to be showing a bid and an ask.
Okay. Do you enjoy being a high frequency developer? Do you like your job?
Yeah, I love it a lot. Yeah, it's great. I mean, I think anybody that is interested in the world of quantitative development or HFT, whether you want to be a developer, a quant researcher, a quant trader, I would definitely recommend it. You'll be working with very smart people on the cutting edge of finance and technology. But I think unlike other industries in finance, it isn't boring. It isn't mundane. It changes all the time. It's not image-based like fields like investment banking. Quant trading is entirely performance-based. And so if you like a cutthroat industry, if you like a dynamic work environment, and a lot of these times, these organizations have a very flat organizational structure. There isn't a hierarchy. So if you like that cutthroat environment with a flat organizational structure, then I'd really recommend you apply for a role in the industry.
Okay. How do you recommend getting into it?
I recommend it all depends on which role you're really going for. If you're going for software engineering, what I can speak towards best is do well in school, show interest in financial markets outside of what you do in school, and also build up a portfolio of pet projects that you can show a prospective employer. I'm actually self-taught. I didn't go to school for software engineering. I taught it all to myself. And to differentiate myself from other candidates who came out of school with a degree, and me recognizing I don't have a degree, what I did is build a portfolio of pet projects that I can show my prospective employer. These people learned and they have a piece of paper and a degree, and that's all and well. I wish I had that degree too, but equally important, I'm showing that I can't. It's not that I can only learn. I can also build, and create some sort of tangible result.
Interesting. That's actually almost exactly what I did for web development. I went to community college for 2 years and landed a super, super entry level job, built a SaaS app, and use those two experiences to leverage my next job.
Exactly. There you go.
Cool. There you go. So you're in Chicago, right?
Yeah, I'm in Chicago. Yeah.
Yeah. So are the two main quantitative development hubs Chicago and New York for the US?
Yeah, I'd say that's pretty accurate. I mean, I think Chicago is a bit of a bigger hub because the CME's here, CBOE's here.
Explain to people what those are.
So the CME is Chicago Mercantile Exchange, and the CBOE is the Chicago Board of Options. So yeah, those are the two major players here.
Okay, sweet. So tell us about your YouTube channel. Where can we find you? What do you go over there? All that great stuff.
Yeah, so my YouTube channel is called Coding Jesus. On my channel, I like to talk about quantitative trading, cryptocurrency, career, and software engineering in general. So if people want to learn more about what I have to say about, my own content, they can find me on my channel over there.
Yeah, and like I said, guys, I really enjoyed his explanations. They were technical, but also the right amount of being able to understand it as an average person who isn't into this stuff. So I highly recommend it. Coding Jesus, thank you so much for joining us today. Is there anything else you want to mention? Anything at all before we end?
Nothing else I'd like to mention. I just wanted to thank you for the opportunity. I'm a small YouTuber, and having you reach out to me was very kind of you.
I know the feeling. So I'm glad to help. So thank you so much for joining us today, man. And yeah, we'll stay in contact.
Perfect.
Thanks for coming on the show.
Thanks, Jake.
Hope you guys enjoyed this interview with Coding Jesus. I definitely learned a ton of stuff and got an entirely new perspective that I've never thought of or heard anywhere else from him on high frequency trading, etc. So let me know what you guys thought in the comments below. If you guys are new to this channel, we do dangerous interviews just like this one for dangerous minds like yourselves for free, so you might as well subscribe because you have nothing to lose and everything to gain, and you can always dislike, unsubscribe, and leave me your best hate comments whenever you want, so you have nothing to lose. You can check out the Coding Jesus channel with the link below. He has great stuff over there with very clear yet technical explanations that I am a fan of. And you can get 2 free stocks for signing up for Webull with the link below. You get 1 stock valued at $2.50 to $200 when you open an account. And you get another one valued from $8 to $1,600 when you deposit at least $100. Thank you so much for watching, and we will see you guys in the next one.